Hi everyone, this is John Lewis with Smart Options Income. Today I want to talk strategy and tactics with you. Talk about one of my favorite option strategies, the debit spread. And we're going to use a recent trade that I did in my Smart Options Income service on Tesla. Now this is not going to be an exhaustive dissertation on the ins and outs of debit spreads. I'm assuming that most of you know what a debit spread is and how it works. But briefly I'll go into it. Debit spread is a directional play. It does require, in most cases, a move in the desired direction. To put a debit spread on, you buy a higher priced call and sell a lower priced call, or do the same thing with puts. The higher priced call or put is usually in the money, whereas the lower priced call or put is typically out of the money. Obviously, they have the same expiration date on the same underlying. And because you're buying the higher priced option and selling the lower priced option, you will pay a debit up front. And this is also the maximum loss that you can incur for this particular strategy. So it is a defined risk strategy. It's just like buying a straight call or put. What you pay is the most you can lose. The maximum loss will occur when both options expire out of the money and therefore worthless. The maximum profit, on the other hand, occurs when both options finish in the money, and the maximum profit then is represented by the width of the spread minus the debit that you pay. Now, when putting on debit spreads, I usually look for lower relative implied volatility. When I'm trading credit spreads, I like higher volatility because I'm a net seller of premium, because I'm a net buyer of premium here, I'm looking for low implied volatility that has a better chance of moving up than moving down. I want implied volatility to expand during the lifetime of my trade so that it increases the value of both legs and the value of my overall spread will go up. So look for low implied volatility environments. I generally look for ranks below 25%. The other thing about a debit spread is it does have a nice return potential. I generally target around 100% max profit or a double. The way you get that is you pay a debit that is about half the width of the spread, and that's something that we did with our Tesla trade. Speaking of which, why don't we jump right in to Tesla? And this was on December 4th, 2018. Tesla was trading just under 360 at 358.29. And the trade was to buy the January 18th expiration 370 put and sell the 360 put. So this is a bearish trade. We use puts for bearish trades, buying the deeper in the money 370 and selling, as it turned out, the in the money 360 put as well. The maximum that we wanted to put this trade on for was $5, but as you can see there, based on the option prices of $30.70 for the 370 and $25.75 for the 360, we were able to get into this trade at a debit of $4.95 or $495 per spread. Now, the maximum value of this spread has a 10-point width, so the maximum value is $1,000. And if that happens at expiration, we would have a maximum gain of $505, subtracting the debit from the width. Now, the break even for this trade is the point at which the intrinsic value of our long put, the 370 put, equals the debit paid. So the price of 365.05 at expiration would represent a break-even level. But notice that that's actually nearly 2% above our entry price. So even though we have a bearish outlook on Tesla, the stock could actually move up to 2%, and we would still have a profitable trade. So it's one of the things I really like about debit spreads. What I want to do is go into three keys to the trade, and these are tactics that I use when I put on a debit spread. I've really talked about the first one in terms of profit. I'm aiming for a debit paid to be about half the width of the spread, and that'll result in a maximum gain of around 100%. So in this case, the maximum value or the width is $10. The debit that we're paying is $4.95. So that's about a 2-to-1 ratio. It's about a double. It's actually a little above that. So we can check off the first box with that, as the debit is about half the width, worth half the width of the trade. The next tactic or key is actually you need no movement in order to be profitable. And I talked about this earlier with the break even. What we want is we want the intrinsic value, or how much the option is in the money, of our long option, so that would be the 370 put, to be greater than the debit paid. Okay, so we want how much the option is in the money to be greater than the debit paid. And what that means is if the stock stays flat until expiration, I understand that that's not realistic, but let's say it stayed absolutely flat, no movement whatsoever, we'd have a profitable outcome because the intrinsic value when we put on the trade is greater than the debt that we paid. So in this case, let's look at the 370 put, the long put. The intrinsic value of that option was $11.71. So you take the strike price and you subtract the current stock price and you get $11.71. But we only paid $4.95 for the trade. So that means that if Tesla expires at any point below 360, which is below our sold option on January 18th at expiration, the value of the spread would be $10, and that would be a maximum profit and would give us a $505 profit. Even the break-even point, as I mentioned before, at 365.05 means the stock can actually increase 1.9%, and we could still have a profitable outcome. Now, this is a major advantage over buying premium because you certainly need to move in the right direction to overcome the headwinds that you have to deal with when buying just calls or puts. So big advantage here of debit spreads. The final key has to do with time decay. And as you know, as a buyer of option premium, time decay is one of your biggest enemies because time decay eats away at the value of your option every single day. So when I'm a seller of options, I'm having time decay work for us. When I'm a buyer of options, I'm having time decay work against us. But when I'm trading debit spreads, I can also have time decay work to our advantage, or at least, at the very least, not have it work against us like it would if I was just buying a straight put or call. So let's look at each of the individual options. The long 370 put, as I said before, has $11.71 of intrinsic value, which means that based on the option price of $30.70, the extrinsic value is $18.99. Now, extrinsic value is the same as time value. Now, let's look at the short 360 put. That has $1.71 of intrinsic value. You take the strike price of 360 minus the stock price, 358.29. That's where you get the $1.71. But the option sold for $25.75, so that means that $24.04 of that option is extrinsic or time value. So we are long about $19 of time value, and we're short about $24 of time value. And what that means is because of time decay, because those time value numbers will decline to zero at expiration, the amount of time decay is greater in the short put than it is in the long put, and that's to our advantage. That means that the net short time value means that time decay is working for us and not against us. Okay, again, when you buy premium, just straight put or call, time decay works against you. When you put together debit spreads like I'm doing here, time decay actually works to your favor. So again, a huge advantage of debit spreads over buying premium. Now the question is, well, why wouldn't you do debit spreads all the time? Well, you're limiting your upside. So if we did if we just bought the 370 put on Tesla and Tesla went down to $300, well, the 370 put would be worth $70 minus what we had to pay for it. My gain, however, with the debit spread is capped at that 100% level because I have that sold option as well. So I'm capping my gain, but quite honestly, I'm willing to cap my gains at 100% and have much better parameters of the trade working for me. I'd rather have, not need any net movement. I'd rather have time decay working for me rather than against me. That's why I like debit spreads over just buying straight premium with a put or a call. Plus, I have to put out much less capital in order to make that trade. If I just wanted to do the 370 put, I'd have to put out $30. But I just put out $5 by adding that sold 360 put. So it reduces my capital allocation by quite a bit and still leave plenty of room for profit. So just a couple of final notes on the way I trade debit spreads. Just a reminder that you need to stay small with your allocations. I usually recommend around 5%. It's pretty easy. You just divide the debit into the maximum dollar allocation, and whatever that is, then you just go with that. So let's say you have a $25,000 account and you have a 5% allocation. That means you can dedicate $1,250 to the trade. Remember, our debit was around $5, which means you could do 2 spreads. Can't go up to 3 spreads. That'd be $1,500. That put you over your max. So you could trade 2 spreads. So keep your size small. Also understand that these spreads tend to move slowly because you have components sort of working at odds against each other. So one will go up, one will go down as the underlying stock moves in one direction or the other. So the net value of the spread tends to move a lot slower than if you were buying just a put or a call. So understand that, even if the stock moves a lot in your direction, the value of the spread might not move up as much as you expect. So it does tend to move slowly. Just one of those things that you need to understand up front so you're not surprised by it. Again, I usually try to buy in the money and sell out of the money. Didn't work out with this case with Tesla, which is fine. But usually you go a strike or two in the money when you're buying on the buy side and selling a strike or two out of the money. That's usually how these trades set up to give you the profit that you want and also to give you that time decay that's not working against you. Keep in mind that these are directional trades, but far less so than just straight buying a put or a call. So while you are dependent on a directional move, that dependence is not as great as with just buying a one option. So the advantage here is that you don't need as big a move in order to profit compared to just buying a straight option. And finally, the important thing about time decay is it doesn't necessarily have to work for you as it did in this case. Just as long as it's not working against you, that's really what you want. It's such a problem to overcome that time decay when you're buying premium. Here's an example of a way that you can buy premium without having time decay work against you. So one of the real advantages of debit spreads and why I really like the strategy for me. So hopefully that gives you some ideas about how you can trade debit spreads. Like I said, I really enjoy them. I like them much better than just buying a put or a call. I think it keeps me in the game longer, allows me to do more trades, and I like the fact that I don't have time decay eating away at the value of my position. So hopefully you'll go out there and make some money with debit spreads, just like I've done with Smart Options Income. Once again, folks, I'm John Lewis with Smart Options Income. Thanks so much for tuning in, and good luck with your trading.